Hi everyone, welcome back to the Property Finance Podcast, and today we are part 3. So Uliana's joined us again. We're going to go through our last set of questions where we have literally gone through everything development finance that you could possibly ever want to know if you're a developer or broker. So start us off with sweat equity. So there's lots of different ways of naming this, but for the purpose of this, we'll call it sweat equity. What are you looking for as a lender when you look at sweat equity?
Well, the secret is in the word, isn't it? Sweat. Did you put sweat and tears into uplifting the value of your site, right? And sweat equity can be achieved by uplifting planning or working planning, or it could be achieved by site assembly and or combination of both.
Yeah.
Some lenders will acknowledge this soft uplift, planning gain, whatever you name it, for loan-to-cost calculations and include it in loan-to-cost. Some lenders will not acknowledge that and just stick to the hard cost that went into the project. So your purchase price, your acquisition cost. Stamp duty is a tricky one. Some acknowledge this, some don't. And any cash that went into the deal will be acknowledged. And the rest of it was like, oh, this is not real cash. But the reality is, it is. If you spend 2 years of your life working, planning, and buying bits and pieces and putting them together and making something work, that should really be acknowledged. So the key is to identify and understand how each particular lender treats sweat equity. It's not uncommon for a lender to accept 50% of the uplift.
Yeah.
That means if the lender accepts 50% of the uplift, that 50%, that soft cash, can go in and be treated as a hard cash for loan-to-cost calculations.
Yeah.
I know it confuses the hell out of people, especially the brokers understand, borrowers most of the time not really. But that loan-to-cost is often the limiting factor. And even if the lender goes to 90% loan-to-cost, that is often, when you have planning uplift, that would be the limiting factor for the development finance facility. So the more things they can squeeze into your cost, the better. And if 50% of sweat equity can be acknowledged, 50% of that planning uplift can be acknowledged, that helps you to get a better, higher development finance facility while still falling within your loan-to-cost covenants. But that question that needs to be asked for your little red book or black book or the Excel spreadsheet, saying, how does this lender treat soft equity?
Yeah. Because whenever a client comes to you with a set of numbers, you need to be able to know, right, okay, they don't want to put as much money in, so I know I'm going to have to go to XYZ who are going to treat it more favourably than maybe some of the others. And I think it's fair probably to say that most challenger banks who are probably at the lower end of the interest spectrum probably aren't going to accept it, as well as maybe some of the lenders who are at the higher end of that spectrum of interest. They're probably the ones who are going to push the boundaries a little bit further, I think. But obviously you're paying a cost for that, for them to push those boundaries.
You will be surprised. It's all down to credit and policy metrics and whether the people who make decisions around the framework understand what soft equity means or sweat equity means. Some lenders will even go to 100% loan-to-cost on the hard loan-to-cost basis.
Yep.
Meaning there's no cash left. There's no hard cash left in the deal, just the goodwill and the hard work the client put in. That is quite a commercial proposition. Yeah. And some lenders will do that, but you need to figure out who does, and then you know where to place it.
That's probably more on the land assembly deals as well, isn't it? Where they've brought together 6 back gardens, for example. They've done all of that hard work of signing up 6 different landowners, all on 6 different option agreements, all to accumulate to this one final deal that you then go and finance. Because I think if you went and did an option agreement over one plot of land, I just find, and this is probably an opinion-based thing, but I just find lenders don't look on that maybe as favourably as the land assembly deals, where you can just visibly see how much more effort has gone into it and, well, how much more sweat has gone into it in terms of combining those.
You almost need to sell the journey. You almost need to show how hard the client worked to get you there. And think about 6 plots of land, 6 back gardens. That could be 18 party wall awards. Go figure that.
I mean, it's a lot, it's a lot of work, isn't it? And it's I think that's why it's looked on slightly more favourably. So, touching on soft loan to cost versus hard loan to cost, just go into a bit more detail on that side. So we touched on it briefly.
That's a good one. So the hard loan to cost will typically focus on just hard cash that goes in. And interestingly enough, stamp duty. So many lenders will say, oh no, we don't take stamp duty into account because we don't fund stamp duty. Fair enough. You don't need to fund stamp duty, and stamp duty doesn't have much to do with loan to value day one.
But it's still cash
but
in from
it's
the
a
client,
cost.
isn't it?
Exactly. Client paid hard cash for stamp duty. Whether it adds value to the site or it doesn't, the money still has been spent. So it is true and genuine cost, and it definitely needs to go into your hard loan to cost calculation. And so many lenders historically haven't done it, left it out, and just keep using the same formulas, same viability models, not realizing that actually we're penalizing the client here because historically it wasn't included. And then if you think about another element which is really powerful, and see if you can use that. Imagine the site was purchased a couple of years ago and you used bridging finance for that purchase. All of the interest, all of the finance costs that the client spent during those couple of years, those are costs, and they're hard costs. Somebody paid the money to this bridging lender to keep the site. There's a cost of maintaining, holding, owning the site. All of those should really go into loan to cost calculations.
Yeah.
But if you dig deep and check, more often than not, those costs are not actually included in total loan to cost.
And the whole reason they're doing the loan to cost is essentially, to boil it down to its most fundamental, is lenders want clients to have a minimum of 10% in the deal because they want the client to feel a bit of hurt,
the pain,
if something goes wrong. And I think, like you said, the fact that some don't take into account stamp duty, that they don't take into account interest costs, legal costs, whatever, the client is still going to feel the pain on those costs, whether it goes ahead or not. So I think from that side, I do completely agree with you that stamp duty should be taken into consideration, previous costs should be taken into consideration, because clients are going to feel the pain on that, whether they like it or not. So, and a lot of lenders, like you said, don't really seem to see that, I don't think.
That's true. That's skin in the game. Anything that has been paid by the client is already skin in the game, should be taken into account. So the hard loan to cost treats and relates to all the hard cash that has been put in. The soft loan to cost will include that planning uplift that goes in, but we know it's not hard cash, it's a value created inside.
Yeah.
But then, to confuse it even further, for some lenders, if they acknowledge part of the soft equity for loan to cost calculation, then they would take that bid, put it into the hard cost, even though this is not a hard cost, and they would base hard loan to cost on those costs, including the soft uplift. I know it doesn't help, and this is where it's really important to understand how those values are calculated. But it's also, you'll only see it and you only have to really challenge it and deal with it if the covenant that restricts your loan is a loan to cost covenant. Then you start digging. Okay, so how is it calculated? Did we include that? Did we include this element? Oh, we also paid decontamination cost, or we paid demolition, or we paid design cost. Can we include all of those? And the answer is yes, we should, which will help you to get better terms for your client.
And really, see, that's because if you hit the loan to GDV covenant,
that's it. Yeah.
You can't really do any more than that, can you?
Precisely.
Once you've hit that, there's no negotiation past that, really. So, and in terms of, we've kind of mentioned the original purchase price a couple of times. So why is that element important?
Oh, this is the best, right? Original purchase price is probably the one element that is missing the most from development finance inquiries when they first submitted to the lender.
Yeah.
And there are a few reasons to that. Firstly, if the site was purchased a few years ago, 2-3 years ago, and the client enhanced the value of the site, the brokers would tend to present the site and talk in market value terms.
Yeah.
And sometimes they would even say, they put the market value in, but they will call it the purchase price without realizing the actual purchase price was not that. The original purchase price was lower. Now, the original purchase price have to be given to the lender with the initial inquiry, exactly for the reason we just discussed. The calculations, the original purchase price goes into your loan to cost calculations.
Yeah.
And pretty much every lender out there will have loan-to-cost covenant, maximum loan-to-cost they're prepared to go to. So if the lender was given the market value instead of the purchase price, and that market value is higher, and the lender accidentally put the market value in the purchase price field or calculation formula, that loan-to-cost is going to be wrong.
Yeah.
And guess what? We will find out what the purchase price was 5 days before completion in the report on title. And at that point, you take that purchase price, you put it in your loan-to-cost formula, and you suddenly realize you're above your 90% limit or you're above your 100% limit, and you realize there's no cash in the deal. In fact, the client is cashing out and walking away with a couple of £100,000 before they even started development. This is where the deal falls apart. And this is the most damaging thing anyone can do to a borrower. Now, the borrower could be completely innocent because they didn't misrepresent the story. They just gave you the market value. Nobody asked them about purchase price.
Yeah.
They didn't think about it. They purchased the site 3 years ago. Exactly. And they proceeded and spent money and time on this process without realizing they're going to be hit with the loan-to-cost covenant breach later on.
Not ideal. No. Talking of things that come up at the last minute then. So the next one I want to talk about is borrowers who have got adverse credit. And this can come in any format whatsoever. There might be IVAs, bankruptcy, missed payments, whatever. There's a tendency within development finance, with it being asset-based finance, for some lenders to almost kind of disregard a client's kind of credit file, if you like. So from your perspective and your experience, what have you seen on that side of things? Has it been like that, or have you found that it's been a bit more scrutinizing than that?
I think with development finance transactions, borrowers' past behavior is almost an indication of future behavior. Yeah. And when we're entering into development finance transaction, you're going to be working with this developer for the next 12, 18 months, 24 months, however long it takes. You need to know they're good people. You need to know they're going to pay the bills. You need to know they do what they said they're going to do. Yeah. So actually, adverse background is really important to most lenders. There are some lenders who will purposefully accept developers with adverse, but they will also charge accordingly.
Oh,
and
of course,
we know who they are. Lenders who are a bit more careful or cautious or better price lenders will be looking at adverse. They will have some guidance around what is acceptable, what is not. Yeah. So if you have a couple of missed payments because you moved a house, nobody cares about this. As long as there's evidence to show that you moved house around the time where you got a couple of missed payments, it's typically is well received. Even if you have a CCJ that was settled very quickly and there's evidence of that and there's a bit of documentation to support the story, the backstory, and it makes sense, most lenders will accept it. Some lenders have very strict policy, no adverse whatsoever. Just if you have any, tell us, move on. Which is, again, we love the quick no as much as we love the slow yes or the worst thing is to start dragging the client through the process, and then the lenders run the credit checks and the credit searches, and the adverse is coming to life. The one thing to be mindful of, if the client does have adverse credit, give the full story. Prepare yourself, because questions will be asked. Yeah. You can't just sneak in, we had a couple of CCJs or we had liquidation. We need the full story. Yeah. And if the lender cannot get comfortable with the full story, quick yes is better than a slow no. Quick no is better than a slow no.
So in terms of, do you want to do that one again?
No, I'm a human being. I'm allowed to make mistakes. We can do that, right? Include that in the bloopers.
So in terms of so we've kind of spoken about the borrower, but actually there tends to be a little bit more scrutiny on the construction company sometimes, because I think there's a lot, especially at the moment, a lot of main contractors and construction companies who are going bust. And yes. I don't think that's it's very well documented across various news sources. So I think from a lender's perspective, how much due diligence are you doing on those construction companies? What are you looking for? And as a developer, so if I'm a developer coming to a broker or a lender, what do I want from that construction company behind me? What have I got to show? What does a lender want to see?
It is astonishing how little due diligence borrowers do on construction companies. It's even more astonishing that there are development finance lenders out there that don't do any due diligence on construction companies. And they almost rely on the monitoring surveyors to kind of look into the background. And it is partially the job, but equally, the lender, it's lender's money. We need to protect our money.
Yeah.
So there are a few things you can do. Of course, you want to look into the training history and you want to look into financial accounts. And the longer the company has been around and the longer you have the financial accounts information out there, and it's a clean financial records with no CCJs and late payments and liquidation administration backgrounds, the better.
If you're looking for a certain amount of turnover from these companies in terms of, because we know they're always 18 months out of date anyway on Companies House, but are you looking for a certain amount of turnover to justify that construction company?
It's all relative to the size of the project.
Yeah.
And construction companies often don't have strong financial accounts, but as long as they're not, for smaller projects, as long as they're not underwater and there is reasonable turnover, reasonable activity there's a bit of profit generated. For smaller projects, it's acceptable. For larger ones, you go into a lot more scrutiny. But one of the most important things that many lenders don't actually do, and definitely not the borrowers don't do, is the director's search on construction companies.
Yeah.
Because as you know, the percentage of default in the industry is 20 to 30%. So many construction companies default and go into liquidation, close the companies, and then open the next one.
Yeah.
And off they go. They go searching and tendering for new projects. And only once you start digging into director's report and you check what exactly happened to the previous company owned by those directors, this is where the true picture unravels. And there is so many of them that I found in my experience, liquidation backgrounds, creditors unpaid, millions in debt to creditors. And guess who those creditors are? You start looking at the creditors list. All of them are suppliers. Your bathroom, your tiles, your small guys who really potentially are going down now because they haven't been paid the 30K, the 40K, the 100K, etc. And then you start thinking, well, if they haven't paid those suppliers, who the hell are they going to use for your project? Yeah. Who is going to give them credit line? Who is going to provide them with materials? That means they won't have credit lines. They'll have to pay cash up front. Now, who is going to cash flow that?
Yeah.
Do they have the cash to pay up front? So luckily, when lenders do those checks, and some lenders do, that helps the developer to screen the construction companies they're considering. And there have been cases where developers dropped the construction companies that they were looking to engage with because the lenders have done the due diligence, and that's really helpful, I think.
Yeah, we've had a couple where the QS has come back and said, we just don't think this contractor is strong enough. And off the back of that, the client has then turned around and said, well, okay, I'll go and re-tender to however many different companies and find one. So in terms of, so we've kind of spoken through the adverse credit and construction company and everything else, there is a tendency for lenders to move the goalposts. And that's, I don't think is unfair to say, but I think some of it does come down to quality of broker as well. So I'm going to sort of take a little bit of the blame off lenders, but there does tend to be this tendency to move goalposts. And what is the reason behind it? What's driving that? Is it funding lines? Is it poor credit decisions? Is it poor brokers? Is it lack of information? What's causing these goalposts? Because there's nothing more embarrassing as a broker than getting halfway down. I mean, literally just before we recorded this, I jumped on LinkedIn, just having a quick scroll, and saw a post from a broker who's had this, where they've gone through valuation, QS, everything else, got to the point where they've paid all these fees, and lenders moved the goalposts.
Okay. This might be slightly long. No, it's okay. It's a really good question. And I know it's probably the most annoying thing in the process, isn't it?
Absolutely.
So there are a few things here. First, the last thing the lender wants to do is to spend time, weeks, months working on a deal and not completing it.
Yeah.
We're in the same boat. Yes, we are paid the commitment fee, but that commitment fee is
Well, not every lender is, though, are they? I suppose that's the thing, is some of the lenders that you've worked for have charged those commitment fees, but there are lenders out there that don't don't charge those and still move the goalposts.
Some don't, yes, but even the ones that do, that commitment fee is not significant compared to the cost of the underwriter running the deal and the origination team and the credit team and all the support team and stuff. So the last thing we want to do is drop your deal. We want to complete. If we started the process, we really do want to complete it. Trust me, we are remunerated for this. We have our own goals and targets and performance reviews, etc. We want to complete. The reason why the appetite might change, it's twofold. First, if the deal was not presented to credit up front and it's only presented to credit at a later stage, that means that the terms of the deal from the outset, that was the salesperson, the originator's best guesstimate around what the credit might like.
Yeah.
And of course, this is all opinions. The lender may think, or the originator or BDM may think, oh, this is a cracking deal. And then it lands on the credits desk and it's not such a cracking deal. And maybe it's the complete opposite of cracking deal, right? So this is where the early exposure to credit is essential for your peace of mind and client's peace of mind and everyone else's peace of mind, really. And some lenders have it built in the process, and that's really beneficial and helpful. The second reason, and I think that one is probably a lot more frequent reason for the lender to change its mind, is when the deal first presented to us, it's a fairy tale. It's a lovely story and everything stacks up and everything works and, there's no adverse there.
And then the reports start coming back.
And, there's no contamination on site. And no, we have never had any liquidations and, and the cost X and etc. And then the due diligence starts and the reports start coming back and all sorts of surprises are coming out of the woodwork. Think about overages. Oh, we haven't even touched on overages. But
no,
we can talk about this forever. All sorts of things coming out of due diligence that even the broker may not have been aware of.
Yeah.
And the truth is, I don't think the broker was aware of those things in those cases because you would have disclosed it to us.
Yeah.
You don't want to waste our time because you're also wasting your time. So when those things come out of the woodwork, in so many cases, they change the nature of the transaction completely. And this is where it goes from, oh, we really like it, to we absolutely do not want to do it.
Yeah.
So is it right to call it the lender changed the goalposts? I'd probably say no. It's a fundamentally different transaction, and on this basis, again, if the lender can make it work, they will try. They will try really hard because they have been in this deal with you for all of this time. So they will try to make it work, but sometimes it's just the differences are, what's the word?
There are some fundamental ones, yeah. I mean, there are times where it does feel, from a broker's perspective, from a client's perspective, that you get to a certain point of the transaction where maybe lenders have run out of money. The funding lines are drying up or they've overexposed themselves somewhere else. And I think there comes a point where it does feel like a lender just wants to try and get out the deal. And I think that it feels like it comes from credit more than anything else. So it feels like there's an underwriter sat there who goes, do we really want to do this? Let's find a reason not to do it.
Mm.
And I think we've had that a few times where we've maybe had an overzealous underwriter on a deal. And it does feel like it kills a deal very, very quickly. And I don't know whether you find that or not with the underwriters, whether sometimes you just feel like you just want to grab them and shake them and go, just have some common sense on some of them and just look at the deal as a whole and look at everything that's been presented and take a commercial decision. Because I feel like sometimes underwriters are too defensive. And I don't know whether I know it's their job. I know that's essentially what they're paid for. Their performance is based on not drawing down poor loans, essentially. But I don't know if you find that sometimes where you just think, just look at it a different way.
You want credit to be consistent. You want to be defensive, but be defensive on day one when you first see the deal, and be in exactly the same mindset 3 months later when you see the same deal again.
Yeah.
Be consistent with your decision. If you don't like it on day one, be very honest about it.
Just get rid of it.
Decline it. I think the risk is the human element comes here into play where the credit, but the underwriter might not like the deal.
Yeah.
But they may leave the door a little bit open to say, well, I don't like it. It doesn't work for us. But maybe, here and there, maybe you can work that through.
Yeah.
And then the team would then jump on thinking, oh, I can pull this off. I can do this, right? We're going to work. We're going to make this happen.
That one chink in the armor is enough for a BDM, a broker, etc., to just sprint with it, isn't it?
Precisely. And the challenge is for you to see that this wasn't a weak approval. This was actually a decline with a little inch of door open to maybe make it work. And it's not worth banging your head on this door. Go and find another door that's wide open for you.
And I think that kind of brings us on to, I guess, the biggest challenges that you see from different points of view. So, I mean, I can kind of cover off the broker's point of view, but from the lender's point of view, what's the biggest challenge that you see within the development finance process?
We hold all the knowledge and all the power as lenders. Now, it's not a challenge for lenders, but I think it's a massive challenge for you, for brokers, for borrowers. And the transparency of the process, what happens, what do we need, what happens next, where do we stand, that could be much better and should be much better for you.
Yeah.
Now, we have the transparency, we know it, but you don't, and that doesn't help anyone. But another element is going back to the initial stage where the transaction is a fairy tale versus the final stage where, okay, this is a reality.
It's the truth, yeah.
This is the truth. Now, if this truth from the final stage was presented to the lender up front, that could have solved so many issues. Now, and here, I think partially brokers are a blessing, but also a curse.
Yeah.
Because some brokers will take a crap deal. Am I allowed to say crap on the podcast?
You can, and they'll roll it in glitter.
Okay.
That's essentially what they do. And I've seen it. There are some of the worst deals you could possibly see, and they just get rolled in glitter, thrown in front of a lender, and then the lender looks at it and goes, "Oh, that looks
works."
all right."
Yeah, exactly.
Yeah.
It works.
And then all of a sudden the glitter falls away, and you're left with the shit deal.
Precisely. Now, the experienced lenders will see it. The experienced underwriters will see it.
Yeah.
But when the deal is first presented, quite often it's presented by BDMs or by the sales team that they are experienced, but they are presented what the broker gave them.
Yeah.
When it's presented at the final stages, this is presented with the benefit of all the deep due diligence, and nobody's covering
reports,
anything in glitter. It's all true facts. And then that's a very different deal. So if we could have kind of reversed the process and almost, well, if it's a weak deal, just tell us it's a weak deal.
Yeah.
Again, quick no is better than anything else. There will be lender out there that will take this deal. There's plenty. They will take the deal. Yes, it's going to be more expensive, but at least they will deliver for you when they said they're going to deliver for you.
And what about from the borrower's point of view? So what's their biggest challenge at the minute? Navigating, I mean, I probably answered my own question there by saying navigating the current climate, but realistically, what do you see as the borrower's biggest challenge in this process?
Honestly, I have so much respect for borrowers for going through this, doing this, and still building our homes. Everything is a challenge. I genuinely, the whole process, starting from planning, even the way we buy sites, even just the whole concept of you're paying your deposit, you're spending money on your due diligence, and the vendor can walk away at any point. That's just beggars belief. That blows my mind, right? And then all the way to planning, and we're not starting on planning, Building Safety Act, we have touched on this, and the finance process. At least from my perspective, I can do something about the finance journey. It's in my power when I join a good lender to make this journey as painless as possible, or as transparent as possible. But everything is a challenge. Everything they have to go through, and then they start on site, and oh my God, your subbies are not showing up. Your professionals are not performing. Your cost of materials going up and down like a yo-yo toy, and it's incredible what they have to go through, and they still do it, and they still build our houses. Massive respect for developers, but if there's anything we can do, brokers, lenders, planners, everyone, we have to do it, because we won't have houses to live in.
And that's the thing, the shortage of homes is so significant, and I don't think anyone quite understands the scale of how far behind we are. I mean, I think on latest data, we're between 160 and 200,000 homes short, and that number just keeps increasing because
Yeah.
we just can't hit those numbers that need to be hit. And I think that's the problem, is that kind of shortfall. I mean, that's a ridiculous number of homes. I mean, it's when you think every SME developers are developing maybe 5 to 10 houses at a time. The larger scale developers are struggling. I mean, there's a few recently that have gone pop and whatnot. I mean, it's a huge scale of development to try and catch up to those sort of numbers.
We won't.
I mean, if you take an average of 5 homes, I mean, that's 40,000 developments that have got to take place just to catch up.
To a degree, the supply-demand imbalance, to a degree, does play in our favor because that drives the prices up.
Yeah.
And it almost helps developers to get out of the hole. Because
that GDV is increasing,
because
during those
it's kind
months.
of because it's precisely, it kind of covers the cost overruns and the time overruns, because GDV goes up, but you still, even if the project didn't quite go to plan, which many of them don't, you kind of still maintain that loan to value covenant, and you're still not in default. So to a degree, it helps developers to continue.
Yeah. To still be able to go, don't they? And I think from the broker's point of view, so I'll touch on the biggest challenge for the brokers, I think, is finding good quality leads. I think is one of our biggest challenges at the moment, is finding quality developers who don't need a complete restructure of absolutely everything. But then it's also finding good quality lenders as well, and it's lenders who you can build that relationship with from day one, that you can then run the entirety of all of your deals through. It's finding lenders who deliver on what they promise, I think, is one of the biggest things for us. And we do struggle with that, I think, and I think many brokers do. Just for a quick scroll on LinkedIn, many brokers do struggle with finding lenders who deliver on what they say they're going to do. For one reason or another, there's something along the line, and I think brokers have to take a certain degree of responsibility for that.
To a degree, yes. And interestingly enough, smaller lenders tend to do better because you have direct access to decision maker.
Yeah.
But then you have the funding line issue where if they go to funding to get funders approval late in the process, then the whole thing goes.
Which is what a lot of the small ones do, isn't it? Because they're still in that process of not quite having that autonomy with their funding lines. They haven't done enough with their funding lines to just be able to go and make those decisions. They have to still get that approval. And I think that's that delicate balancing act of, yes, you've got access to the managing director, but you've got that risk of you get to the end point and all of a sudden the funding line doesn't quite like it. There's been a bit of an overpromise here, or something during the deal has changed. One of the biggest ones we find, and this is one that comes up early on in the deal, because you can't change this element of a deal, but regions. So certain lenders have certain regions that they will lend in. Some will just not touch certain regions whatsoever. Scotland, prime example, Northern Ireland, Wales, quite a lot of the north, some lenders sort of trying to avoid, but there's also lenders who now avoid London entirely. So what is it that's dictating that? Is it the funding lines? Is it just data that's coming into the lenders? Is it just preference over certain areas?
With regions, it all comes down to certainty and confidence. Now, if you look at Scotland and you look at Northern Ireland, the big challenge is capital values.
Yeah, which explains why you can only lend in Edinburgh, Glasgow, or sort of within a couple of miles of those areas.
Exactly. If your capital values are £300 per square foot and your build cost at £200 per square foot and you paid £100 per square foot for land, it just doesn't work.
Yeah.
Right. So just the metrics, the fundamentals of the deal, of development finance deal, do not work in regions, in particular when it comes to, most lenders have profit and cost requirements, minimum profit and cost, 15%.
Yeah.
You just don't hit it. Unless you get the land for free, or you purchased it historically and you have had it forever, or you purchased it really cheap.
Yeah.
It doesn't work. The second element is, when you start looking for comparable transactions to justify your GDV, there are none. you often need to go 3-5 mile radius around your site, and there are no comparables to give you any confidence whether the unit you're building or units you're building are going to sell at the capital value you think they're going to sell. Now, it could be that there is no comparables out there because nobody sells, or there are no comparables out there because nobody buys.
Yeah.
And we don't know that, right? And we sit in London, most lenders, or lenders who sit in London, we have no visibility or knowledge of this region or of these villages and small places outside of our reach, with no sales data to back any numbers that's put in front of us.
Yeah.
You're lucky if you find professionals who are familiar with the areas and they can really give you good insight to say, well, actually, I live here, or I live 10 miles nearby. I know exactly what's happening in those villages. There's massive demand for this. Nobody's building, but because there's no sites going for sale, and and once you build it, it's just going to sell. And you have to trust those professionals to make this work. But it's all around, well, we don't know that. We don't see the actual numbers to support these statements. While in London, it's, you throw a stone and you have 17 comparables for everything you do.
You mentioned about lenders sitting in London, and I think this is an interesting sort of conversation that's come up a few times, is lenders will sit in London as their home base, if you like. They'll then open regional offices, run them for a couple of years, and then all of a sudden those regional bases disappear. What's the reason behind that?
The reason the offices open are the lender's desire to go into regions and lend in the regions, which contradicts the previous point. But anyway.
Most lenders seem to be opening Manchester branches at the moment. That seems to
Manchester,
be the new one.
yes, exactly. But then you open the office, you send a few people there, you hire local people.
Yeah.
What often happens is that decision makers are still sitting in London, and they're none the wiser for the fact that we have Manchester office or Leeds office or one of the regional offices. And also the people who you typically put in those offices, those are often originators, the PDMs, originators, and they shouldn't really be in an office. They should be on the road. They should be meeting brokers, going visiting sites, meeting clients, being out there.
They don't need a base, do they? No.
Creating relationship, exactly. They don't need a base. And once they source the transaction, they can work from anywhere. They can work from coffee shop.
Yeah.
Once they source that transaction, the transaction still goes back to London. It doesn't go back to Manchester. So once lenders realize that actually the physical presence in Manchester or Leeds doesn't give you much, because the people you put there really needs to be on the road rather than in office anyway, and the decision makers are not there anyway. Your credit is there, your management, your leadership team is in London. You almost think, well, what's the value in having it? And since COVID, nobody goes to the office to have meetings in the office anymore, isn't it?
It's all coffee shops.
We all coffee shops.
Zoom.
So the way we work changed. So I think we're slowly moving away from having regional presence. Even though we want to be in the regions, we want to land in the region, we want to support the regions, but the physical presence is no longer needed that much.
No, and I suppose the cost of bringing that management team, your credit team, everything else from London to Manchester, and it's such a phenomenal cost. It probably just completely outweighs the benefit, doesn't it? And I think coming back to the process then, so talking about credit teams and management teams and everything else, we mentioned just earlier that you'd seen 1,000 applications in however long it was. So, in that time, what are the trickiest things you've come across in terms of applications? When you look at these applications, what do you think that's going to be the trickiest part to try and overcome within that process?
The one thing I can say is none of them is straightforward.
No.
You get an inquiry in, and the skill is to be able to make a decision about that transaction here and now.
Yeah.
Because it's very easy to look at the inquiry, look at the deal and think, oh, okay, I can get comfortable with it, subject to X, Y, Z, blah, blah, blah. And you have 17 pages, 17 pages of requirements. That doesn't help anyone. You don't have the, as a broker, you have what you have. You can ask some more questions, but that's the package you got. So can I get comfortable with what you're presenting to me and make certain assumptions about the pieces I don't have? And the assumptions are the pieces I'm missing, the information I'm missing, there's nothing onerous there. And that's a skill. In my view, that is the skill. You can caveat your approval and you say, I'm happy, 65% approval, subject to XYZ, and make it simple, make it straightforward.
Yeah.
And then the onerous is on you to say, okay, I understand we're in partnership now. You made assumptions that there's nothing onerous here. I make assumption that I extracted all information from my client. There will be no surprises, no surprises I'm aware of later on. So the trickiest one is to make that decision, knowing you're missing some information. If you're missing that piece, you cannot make a decision.
Yeah.
If you think about fundamentals, borrower's previous experience, if you have a transaction landing on your desk as a credit person, and borrower's previous experience is just lacking to be confirmed, I cannot make a decision here.
No, because it's a fundamental part of.
Or if you think about development appraisal, it has to be there. You can't just say, oh, it's going to cost me 3 million to build this. Okay.
You need to know how that's broken down.
Thank you. Is it 3 million including 10% contingency? Is it 3 million including 10% professional fees or new build warranty as we discussed, etc.? Is it 3 million including demolition? Is it 3 million including decontamination, etc.? If you don't have development appraisal included, you cannot make a decision because then you're just guessing your cost. And the reality is you're just wasting your time.
Yeah. One of the trickiest things I find, and this is talking from my side, is source of funds. That seems to take up a huge chunk of time. And we've got one actually at the moment where the source of funds has essentially at the last minute, we found out that the funds have come from South Africa, which obviously is on the blacklist, shall we call it. So that is, from a lender's perspective, they've got to dig into that a hell of a lot more than they would if the funds were coming from France or Germany, for example. So, or Switzerland or wherever. So there are a number of countries that obviously cause a problem. Why is it, from your perspective, from a lender's perspective, why is it that that source of funds sign-off has become so onerous?
Painful.
We know why it's so painful. And then also the FATF blacklist. Why is that such an issue for lenders as well? I mean, obviously, it sounds like a stupid question coming from me, but from a developer's perspective, imagine I'm a developer asking you, well, why can't I have money from Ukraine, Russia, whatever? I mean, obviously, it's fairly obvious why, but yeah, let's just cover off that briefly because I think that it comes up on a lot more deals than I think we expected to.
Indeed. The regulations around anti-money laundering, CDD requirements, which is customer due diligence, or AML requirements, and anti-money laundering, we talked about this, they have been tightening over the years.
Yeah.
Now, for the regulator, it's much easier to control financial institutions rather than controlling individuals.
Yeah.
So they impose restrictions or obligations on financial institutions and now on lawyers as well.
Yeah.
And as a result, then we have to do the work to comply. There are countries, the FATF list that you mentioned, there are countries on the grey list that require extra attention, and there are countries on the black list, in particular countries under sanctions or countries with weak regulations where we cannot rely on them complying with money laundering regulations, where if the money is coming from those countries, there's a higher risk that those funds were generated for criminal activities.
Yeah.
Now then the onus is on us to get comfortable that we are not involved in laundering criminal money.
Yeah.
And if you think about, well, what do you care? You're giving money, you're not getting money. But the reality is we are, because we're funding a site where criminal proceeds might be involved in the purchase of the site.
Yeah.
So inadvertently, we are then involved. And
especially as construction is predominantly it probably shouldn't be, but predominantly on site is a very cash-driven business as well. It's probably one of the last remaining really cash-driven businesses. So
Indeed.
In terms of laundering that, I think that's wise.
Indeed. That list you mentioned is updated 3 times a year. So whenever you have funds coming or borrowers coming from various interesting jurisdictions, and some of the countries on that list are surprising.
Yeah.
Countries like Bulgaria or Croatia or Monaco.
We've got the list.
You got the list
in front here as well. I mean,
some of it makes perfect sense, but some of them you think, I wouldn't have thought that country is on the blacklist. But if you see anyone, any transaction with funds coming from outside of the UK, I would personally just really quickly check the list. It's not very long, and see whether any of them fall into the blacklist category. Blacklist does not mean we cannot do the deal, but it does mean we have to go through extremely enhanced compliance process that needs to start really early and be quite onerous. And as a broker, if you're familiar with the process, that will help your client to get the transaction through and get the approval through. And sometimes, unfortunately, and I have seen cases like that, if you get a decline, it's declined. You cannot do anything else about it.
Yeah. And I think just looking at the list now, I mean, there's a lot of African countries on there, but Croatia, for example, is on there. Yemen, you've got Venezuela. I mean, the interesting one as well about this list as well is that it actually tells you who's no longer subject to the increased monitoring as well. So Turkey, for example, have been taken off. Jamaica have been taken off. So there's a couple of countries there where actually they're no longer subject to such a high level of monitoring as well, and it's quite a surprising list. Some of them that you see on there. Like I said, I wouldn't necessarily have expected a couple of them to be on. Monaco's on there as well.
Indeed, Monaco. And out of all countries, Monaco is the one. But even the grey list.
I probably more I think about it, actually, I probably wouldn't be that surprised at that one. There's a lot of yachts.
But even the grey list, you will go through enhanced source of funds process. But then again, it's not. If you know what you're looking for, you'll be fine.
Yeah.
And it's all about, can you trace the funds? Can you get documents to trace the money, where it came from?
Yeah.
Bank statements, completion statements, letters from solicitors, letters from accountants. Just get the documents and follow the money to the origin. Once you have done it and you have a set of docs available, you'll be fine. Yeah. Unless it's really dirty, but then you'll see it's dirty.
Yeah, and that's the thing. I think from a developer's perspective as well, we're talking really about developers who have got private investors coming in or family money or that kind of thing. And from a developer's perspective, you shouldn't be looking at this as a negative, I don't think. I think actually this is a benefit to you as a developer. If you've got someone doing that due diligence on those funds for you, the last thing you want is to be involved in anything dodgy. So I think from that side of things, it's sometimes, although it is a painful process, I think it needs to be looked at as a necessary process, but actually this isn't to try and trip anyone up. This is to make sure everyone's protected. This is to make sure that at the end of the day, all of us can sleep comfortably at night knowing that
indeed
something dodgy isn't going on. And I think it leads us nicely on to probably the last question of this 3-part series, which we really have covered everything. I don't think I've ever done a podcast as detailed as this. So I think the last one I want to cover off is the shopping list that development lenders present you with. And it's always quite a lengthy list. It accompanies normally a set of indicative terms, and it often accompanies a request for a commitment fee is probably, for some lenders, I mean, some don't charge a commitment fee, but with many, it kind of accompanies this, you need to pay this fee in order for us to kind of do anything else. So what's behind that shopping list? We've kind of already answered it, I guess, across a couple of questions, in that realistically, this shopping list is probably to save us all a bit of time, really. But from a lender's perspective, what's the reasoning behind it? All of it.
Yes, I love a good shopping list. Okay. Let's go back to that initial approval or the mandate holder making a decision about supporting the transaction. There's so many pieces of information that are typically missing from that initial submission. And it's the nature of the beast. You don't have all the information. Maybe the client didn't share all of this with you. But when the lender comes back to you with approval and asks you a lot of questions, that tells you that this lender is thinking ahead. They're trying to see what might go wrong later or what we may have missed in the process. Because when you have significant amount of experience in development finance, when you see an inquiry, you know exactly what's missing and you can see where this can trip you over. So what they're trying to do, they're trying to prevent this transaction from falling over later because of the information that was not made visible to the lender from the outset.
And it's trying to save costs in terms of there's no point a client paying for evaluation, QS report, etc., if half of that shopping list doesn't exist or isn't readily available. So I think that's the other thing, isn't it? Is it's the lender's aim or or hope that they can save a bit of cash and build a bit of a relationship early on as well, I think.
It is client's cash, exactly. The last thing we want to do is for the client to pay for VAL and IMS and then something comes out of it. So, but equally, the information we're asking for, it will become available later, but we just want to make sure it's okay.
Yeah.
In particular, you know how we said sometimes the approval is given subject to.
Yeah.
So the subject to are key. You just want to make sure there's nothing dodgy there, there's nothing adverse there, there's nothing concerning there. Just tell me about this. If there is, tell me about this in advance. I'll go back to present it to credit. Lenders who don't send the shopping list back to you early, I would be a little bit concerned because I have never seen a deal, even transactions coming from the best brokers out there, I have never seen a deal that everything is presented to you on day one, never. Yeah. It's always a skeleton, it's always the foundations, and you always make some assumptions and you hope they're going to be fine, but that's the reason why we would ask all of those bits and pieces. I'll give you a small example. We may ask about party wall awards. We may say, well, can you confirm whether party wall awards are needed? Yeah. If the answer is yes, my next question would be, have you started the process?
Yeah, because if not,
precisely,
there's that time scale.
And if they haven't, I'll prompt them to start the process. Yeah. They will have to finish it before we complete, but at least I help them to kind of start thinking about it. Go talk to your architect, go talk to your party wall surveyor. You need to start the process now.
It speeds the process up for everyone then, doesn't it? Because otherwise we're 2-3 months, however long it's going to take to get it sorted.
Exactly.
If it comes up at legal stage, it's another 2-3 months that no one accounted for. And often vendors have got a timescale in mind of when they want to complete. And if all of a sudden you're adding 2-3 months onto that, it's...
Indeed. And some of the shopping list is really to help the borrower to start certain elements of the process so that they complete those elements before the drawdown date.
Searches as well. That's another one that I think is on many shopping lists, but should be on more potentially, is what searches do you need as the lender? Because, often some of them can take, local searches at the minute are 6-7 weeks to come back. I think highway searches are 5 weeks to come back. So all of these things they can add huge delays on. So I think it's very much needed, that shopping list. I'm going to ask you one last question then before we finish. What's your one key bit of advice? And it could be for anyone, for developers, for lenders, for brokers. What is that one little nugget that you've got? Put you on the spot.
Okay, well, I think if it's for everyone, I would say talk to each other, ask questions, lenders hold the knowledge. Pick up the phone, talk through. And if it takes an hour, take that hour. You, as a client, as a broker, you deserve the lender's time and the lender's attention. You're paying for it. Yeah. Get the clarity about what's going to happen next. Where do we stand? Did the credit like my deal? If they didn't, what was it they didn't like? What do I need to work on? What's going to happen next? When are you going to credit again? Are you going to credit again? Yeah. This offer letter you issued to me, I don't understand clause 17. Talk me through. Pick up that phone and get all information you need from the lender, because we have it. You don't. We don't have the way of sharing it with you just now. We don't have most of us don't have the technological solutions and platforms to give that transparency. Yeah. So extract it from us, because it will help you to help your client. And we're here to provide, this is financial services. We're here to provide service. So you deserve it. So ask for it. If the lender is not giving it to you, demand it and get it.
Brilliant. There we go. Thank you so much for joining us for 3 pretty in-depth parts. It's been a lot more in-depth than I think any of us expected. So from my side, and I'm sure for everyone who's listening as well, thank you so much for joining us and imparting so much knowledge on us. And to everyone who's watched through all 3 parts and listened, thank you so much. And we'll catch you on the next one.